Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. Well, we're dealing with, over the past couple weeks, over this long winter, has been a series I'm doing by request on long-term health care for retirees and seniors. The reason I was doing this is there's so much confusion over the whole issue of retirement planning that it seems hard enough as it is. But what often gets neglected is, for me, what is the hardest single area of all of retirement planning, maybe all of financial planning, which is long-term health care and the impact that it has on finances. So here's my struggle, and I said this in a couple of the shows. I don't know what to do. I thought I did 25 years ago, buy long-term care insurance, but it's not so easy now. First, it depends on a person's age, whether they can even qualify for long-term care insurance. And secondly, it depends on the insurance company's health, whether it'll even be there 20 or 25 years from now, which is what we're buying the policy for. We're not buying it for now. When we buy homeowners insurance, we're buying that coverage. Our home might burn tomorrow. When we're buying long-term care insurance, we have a very real likelihood when we're 55 or 65 years old and choosing to protect our loved ones if we should go into a nursing home, that we're buying a policy that we don't expect will be called upon, if ever, for at least 20 to 25 years. So what we're really doing, if we're buying insurance, is we're buying a partner that we ask to be there to pay our bills for us 20 or 25 years from now. Well, 25 years ago, I thought I knew the answer. Now, I've been in business since 1976, and this area of financial and retirement planning has become the single most difficult area for me to plan, bar none. I have no easy solutions, but I do have solutions. And I've learned this in my whole career. I keep looking for the perfect solution for each area in my client's needs. And I learned a long time ago, whether it's enough money to retire on, or whether it's enough insurance for even your kids, if something happens to you, to provide income to get them through college, or enough savings to pay for college, or enough of this or enough that, disability protection, enough anything that you're trying to do. I'm always looking for the best. What's the best solution? And I learned a long time ago, don't stop trying to look for the best solution, but stop, let's say, postponing or procrastinating decisions until you find it. My big problem was I was, and still am, afraid to make mistakes in decisions I make, finding out a year or two later, oh, this other opportunity or avenue or product or vehicle existed and I didn't do enough research, didn't know about it, so I made the wrong choice for either myself or my clients. So that was always a worry of mine, and it still is. So that brought me into always trying to look at every option. So let's say I'd look at life insurance, and I'd say, okay, I'm looking at life insurance for someone. Let's look at term life. Let's look at universal life. Let's look at guaranteed universal life. Let's look at whole life and all the other variations. And I'd say, which one is best for these people? And I'd get confused, or I'd confuse myself with which one is perfect. While I was attempting to find which one is best for their situations, if I found anything wrong with each choice, I'd throw it off my desk onto the floor and go to the next one. In other words, I would discard every choice. And what I found myself doing is having an empty desk with no other choices to consider. So I ended up going to the floor, picking all those options back up again, realizing, hey, Jack, you have to choose one of these because there are no other options, and you've already proven none of these are perfect. So now I have to go back through them, reevaluate them. All right, which one's least worst or least bad or has the least amount of problems or is at least closest to being the best of a bad lot? You see what I did? Well, now we come to long-term care planning. This is a nightmare, folks, but I'll tell you the one solution that most every household is applying right now. And that solution is avoidance of the issue, procrastination, ostrich head in the sand. It'll never happen to me. Honey, take me back in the backyard and shoot me. Or kids, never let me go into a nursing home. Or I have enough money, it'll take care of me. Everybody that says those things are practicing avoidance rather than solution planning. So I'm imploring everyone to evaluate all of the options I'm putting out on this radio show series. Whether it's have your kids take care of you, then evaluate that. Maybe that is the best option. Or go have a home health care agency provide the care. Or go into a nursing home and have enough money to pay for it, or have enough insurance to pay for it, or use life insurance to replace the assets, or do Medicaid and Veterans Administration planning to protect your assets with the attorneys. It doesn't matter. What I want you to do through this series is educate yourselves to the at least different options that are available, and including the do nothing option, which is an option. And then you now are equipped with all those arrows in your quiver to choose which arrow at the time of need, if there is a time of need, which arrow is the best one for you to have shot 20 years ago that'll hit the mark when you need it. So in our series, I went through the do nothing plan. I went through the having the son or the daughter already. I mean, we're already into part 5 of this series, and you can get this series by email. I video these, as many of you know, and it's on the radio show every Saturday morning from 8:30 to 9 a.m. on 1080 a.m. WWNL radio. So you could get access to this step-by-step process I'm taking you through. But you could spend all your assets. You can do all these different options. Well, today, we're going to start into that next part of this series, which is spending all of your assets, or do you have enough money to self-fund nursing home costs? Now, when I say nursing home costs, that brings up in-home care. What I normally would want to do is what I hear every family asking me: we want to stay at home. So I say, okay, do you want to be a burden on your family? I had a couple in here just last week. One of my biggest worries, they said, was being a burden to my family. It's time to make sure we're not ever going to be a burden on our family. So I looked at this and I said, I had another client who had come in, another couple, and the husband in that case needs some care. And I said to the wife, do you know there's some assistance that's available? And she said, absolutely no way would he go for that. So while I lay out these wonderful plans, we'll get government benefits, we'll get governments to pay for health care in the home and aides coming in, and they could do all the things that they could do in a nursing home, and we'll keep your spouse at home where they'll be happy. Guess what? The person who's the spouse receiving or needing that type of care, the Alzheimer's patient, stroke, dementia, something like that, many times they won't allow anyone other than a spouse to provide the care. It's personal. So we have to factor all those things into our decisions. How are we going to take care of any one of us if we develop the need for someone else to have to care for us? So the very first step, and I should have covered this in the first show more, is to accept the possibility that at some point in our future, we may not be able to provide all of the care for ourselves. As embarrassing and humiliating and difficult as that might be for ourselves and for our family members, the first step is recognizing and accepting the risk that it might happen to us, and there's nothing we can do about it. How do I know there's nothing most people can do about it? Because if somebody's number's up and try to not catch the next cold or flu the next time the cold or flu comes around your way. Say, no, I'm not getting this. I've decided I'm not getting a cold or a flu. Try that. And when you succeed at that, or after that failed experiment, then begin to appreciate the reality that things that can happen to us physically or mentally can happen to us beyond and out of our control. So what's in our control is an ability to determine in advance what impact we allow that to have on our finances and our family if those uncontrollable and unpreventable circumstances happen to us or a family member. So I go to the computer, I go over here, I go do all my research, and I come back with you and I say, guess what? I don't have perfect answers, but I do have answers. Here are your choices. I'll run down through them again. We're doing them through this series. Number 1, do nothing. Procrastinate and avoidance. And maybe you'll get lucky. And maybe it won't happen to you. But maybe it'll happen to a spouse. So be careful there. You're spinning the wheel with 2 choices, not 1. How about you kids? Could it happen to your parents who are avoiding it? Because one of you might have to quit work or whatever, deal with the burden. And I talked about that in a prior option. So step number 1, do nothing. Option number 2, my son or my daughter will move in with me or whatever and take care of me. Step number 3, I'll give it all away. Step number 4, we'll just spend it. If I'm single or I'm married, we'll just spend it. We'll just use our money, and if there's nothing left, there's nothing left. I covered all of this. Step number 5 is where I am today. Do you have high enough assets? If I'm dealing with a family or a business where the business owner or the family, as a married couple, let's say, have enough assets that there's enough interest being earned on those assets that's not being used, not even being touched, that is accumulating in the account, and that amount of interest every year equals or exceeds what the cost of nursing home would be, then we might be finished. We might not be, because even if it is enough to pay for it, we might not see that as the best option of how to pay for it, but we might too. Let's take that example. It costs today roughly $10,000 a month to be in a skilled nursing home facility. If you're a dementia or Alzheimer's patient that has no ability really to be cognizant or physically able anymore. If it's assisted care, assisted living facility, might only be $4,500 a month. Or it might be even $3,500 a month. So let's look at those examples. We will see most diseases, I'll call them, or conditions that drive people into a nursing home we find mostly they are progressive diseases or conditions. And that means they start off little or on the surface level, and they progress to be more and more comprehensive and more difficult to manage. In other words, deteriorating health over a period of time, gradual period of time. So when you're wherever we are is a snapshot in time. Hey, I have a spouse and we're taking care of them at home. Well, if they need some care at home, you better look to the future, because it's likely that the type of care they need right now is not going to be able to be adequate 5 or 10 years from now. They're probably going to need more and more. How can you test this? Just look back 5 years to where that person was and how much care they needed to where they are now, and you'll see what I mean. Dementia is a classic for that, where it continuously seems to degrade and cause more and more dependence on other people to take care of them. So that comes to our finances. We might be starting out at $4,500 a month and ending up at $10,000 a month. But it won't end at $10,000 a month because of inflation. So it'll go from 10 to 11 to 12 to 15. And if we're planning now for what might happen 20 years from now, I have to use double. I have to use $20,000 a month, because it was $5,000 20 years ago, and now it's 10. So we have to be careful in our planning. And if that person needs or can get care at home, adequate care at home, which is a higher bar and harder test than you think it is, it's more than it costs to be in a nursing home in many cases. So you have to be careful. But let's pretend, for this example, the cost of care is $10,000 a month in a nursing home. $10,000 a month is $120,000 a year. $120,000 a year is 10% of $1.2 million. If you have $1.2 million in the bank and you're earning 10% interest, you may have enough capital assets, a resource that is not being used and not being touched, to then turn on that interest payment to provide payment to the nursing home for the cost of care. And you may be able to 100% fully cover the cost of care, interest only. What if you have $12 million in the bank? Well, now it only requires 1% interest, doesn't it? Because $120,000 is 1% interest on a $12 million bank account. So now, if you have large enough assets, you could take the first 1% of your interest payment every year, which in today's temporary economy, that might be all of the interest, might even be more than all of the interest. But for this example, 1% interest, if you have $12 million in the bank, you may not need any outside financial help to solve this problem. So what do we then do? Well, you may have to carve out the assets. You may have to allocate them to make sure they don't get lost in a car lawsuit or something like that. You may have to protect assets. So you may do planning with attorneys, but you may have adequate resources, which brings up another point. If you are then drawing interest, isn't that taxable? Well, depending on the type of account, it is or is not taxable to draw that interest out. But let's pretend it is true interest and it's 100% taxable interest. In a bank CD, in most cases, it would be taxable whether you pull it out or not. If it's an IRA CD, then, and I'm using banks to keep this simple, then the IRA 1% a year that you're earning for all the years you're not withdrawing would be tax deferred and not currently taxed. So if you then begin to pull it out to pay for nursing home, it would then begin being taxed. If it's a Roth IRA, in $12 million in a Roth IRA, and it's possible to get that in there, but it would normally be from converting traditional IRAs over to Roth IRAs. You typically have contributed enough to well, to get into a Roth IRA, that much money. You could potentially in a Roth 401k. I'm way off the subject on how to fund these accounts and assets, but I'm sharing that with you. The traditional IRA, back to an IRA CD, where I say if it's in an IRA, it's tax deferred, so it's not taxable until or unless you pull it out. Let's say in this example for a nursing home, we can't forget over age 70 and a half, everybody in a traditional IRA has to start pulling out of their IRA, which does force taxation on that interest. So there's my elementary discussion on, is the income taxable? My general answer is going to be probably yes. And your question might be, well, if that's the case, then don't you need more than $120,000 a year or $10,000 a month to pay the $10,000 a month bill? And my answer is yes, possibly. I will share with you the other end of the spectrum. Long-term health care costs are usually partially and sometimes wholly 100% fully tax-deductible expenses. Not always. In order for them to be tax deductible, there are charts. The IRS has charts. There are tables. It's age-based. The older you get, the more of it's tax deductible. And most importantly, to be able to satisfy an IRS auditor, if there's an IRS audit and you're deducting that whole payment, the IRS auditor comes out and says, we want documentation from the nursing home, let's take for this example, that 100% of that's tax deductible, the 100% of the cost of care, because the IRS says room and board portion of the long-term care health expense is not tax deductible. Only the amounts going toward the so-called health care portion. And the reason they're saying that is the way you deduct the nursing home costs are through your health and medical deductions. So that means another thing. You have to be itemizing, which if we have those kind of expenses, you probably are, but you have to itemize, and you only get to take the amount that exceeds the first 7.5% of your adjusted gross income. And if you're under age 65, it's 10% of your adjusted gross income now. But the 7.5% of your adjusted gross income, be careful here, folks, because all of the distributions we're taking out of this allocated account to pay for your own nursing home. I'm talking to those of you with $12 million who were not taking that income and now are going to begin taking that income. I just raised your taxable income $120,000 a year, which means I raised the threshold that 7.5% of your adjusted gross income now is a much higher number or bar that you have to get over before you can deduct any medical expenses. So, what's the lesson? Well, what's my lesson in all my shows? I can share with you opportunities. I can share with you generalities. I can shine the light on many different avenues of options, opportunities, and potential solutions that are available. But you can't do any of these on your own and get it right, most likely. You need to get to competent, well-intentioned, and well-equipped with knowledge financial professionals, tax professionals, and legal professionals on your team to help guide you the rest of the way through these decisions. So you go to your advisors with the information I give you on the show. You email me, you contact me, you say, Jack, you know this area, help us build a team of advisors, help work with our existing team of advisors. And let's work this all out together in advance while I'm healthy, while I'm cognizant, while my family's on board. Let's all work this out together to prepare a plan for our future, to make sure that we're financially sound, make sure that it's not devastating to our spouse, or either of us, if either of the other one has this type of need, that it doesn't devastate the finances, which means the life of the other spouse, or places undue burden on the children. Let's iron this out all in advance. So this area of, do you have enough assets? We can spend it on our own. We'll just spend the money. When I talk with people and they say, I'll just carve out $300,000 or $400,000, I say, hey folks, you could be under the false illusion that might be enough to take care of you, but prevailing history is showing, no, it's not. Not enough to rely on. If you carve out $300,000 or $400,000 and say, well, you know what? If a nursing home's $5,000 a year, that's $60,000, or $5,000 a month, that's $60,000 a year. That'll cover us for 5 years. You might be right. And then they'll say, and the average, the statistical length of stay in a nursing home for the average patient is still 2.4 years. And they might be right. So it might work. But I then look at, I have clients that are in there 10 and 15 years. What happens to their families? So we want to be real careful about planning, thinking a couple $100,000 is enough to set aside, because in some cases it's just not. Now, when I look at this whole area of financial and retirement planning, I need you to address the issue that it could happen to you. Nobody that it has happened to wanted it to happen to them, and nobody that it has happened to thought it was going to happen to them. The majority of the people in the nursing home, it is my venture to say, my guess, that had I met with most of them 20 or 30 years ago, having this same discussion we're having now, I believe most of them would have answered me, I'm never going into a nursing home. My kids will take care of me. I have enough money. My parents fell right over. I'll fall right over. They didn't have this happen to them. I won't. I'll bet if anyone wants to do a poll out there, share the results with me if you do, that it's a very high number of the people that are in nursing homes believed it would never happen to them and are now victims, helpless victims of whatever circumstances bring. There's nothing they can do about it. They're helpless victims to their situation, where 20 or 25 years ago, we might have been able to gear plans to prevent at least the financial hardship and the burden to the families. So let's think ahead, folks. Accept the possibility, yes, it could happen to you, and let's work these things out together. Remember, a chain is only as strong as its weakest link in financial planning. Thanks again for tuning in. We'll be back again next week. I'm going to talk about actual long-term care insurance policies, how to choose them, what the difficulties are in finding them. We'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.